Covered calls, short puts, iron condors, double-breasted broken butterfly spreads. Okay, I made that last one up, but my point stands. Options trading terms might sound like gibberish from another planet. And maybe that's discouraged you from looking further into them. That would be a shame, because truth is options can be a powerful tool to help you achieve your portfolio goals, and you don't need to be a pro to use them. So don't let fear and confusion get in your way. You got this. Get ready to take your first steps into the world of options trading. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. Today's episode is all about helping you feel more confident about weaving options into your portfolio. We're going to hear what options can do for a portfolio, some tips that can help you get started trading them, and a simple hands-off way to get exposure to them if trading isn't for you. Plus, we're going to take your questions on all things options trading and options ETFs later in the show, so stick around for that. Let's get down to business here. Joining us is Richard Ho, Director of ETF Distribution for Eastern Canada at BMO Global Asset Management, He has over 15 years of options trading experience, both trading them himself, as well as educating DIY investors about options ETFs. Richard, great to have you in studio here. Thanks for joining us.
Thank you for having me here.
Yeah, I think you're the man of the hour here because you've seen both sides of the coin here. You like options ETFs, you like options trading. You've done both for a long time, so that's awesome. Before we get too deep into our conversation, of course, there's so many like options terms and stuff like that. So I'm wondering, can you give us like the 100-foot view? What are options? What can they do for a portfolio?
Sure, exactly. Options, they trade in Canada, they also trade in the US. Whenever you send an option order on a Canadian exchange, that would go to the TMX. Anything US related, that would go to the US. And now in the US, they will have 17 option exchanges, lots of exchanges. So now going back to your question, like options, it's a derivative contract. So it gives the investor the right to buy or sell the underlying security. The underlying could be a stock, ETF, currency, index, you name it, we might have it. So when we talk about options, people use options to lock in a buying price, selling price, and they get this right by paying what we call an option premium. That's the price that the buyer needs to pay to the counterparty to inherit that right. So options, the other thing that you need to know about is that they have a certain expiration date. So after that date, this option contract would disappear. So investors, they trade on this options market to buy and sell the underlying because of their market outlook.
Okay, so I think a lot of people could wrap their head around the idea that, hey, like an option is a contract, right? Okay, there's a buyer and a seller, and there's some terms to it. The terms are active a certain period of time. Are there certain strategies or goals that somebody would try to accomplish by using options?
Options has so many different strategies that you can use them, right? Like for investors who are bullish on a certain stock, they can buy call options. If they're bearish on a stock, they can buy put options, right? And then after, options can also be very great tools to generate additional income. So that's the second thing. Now the third thing is that you can also use options to hedge a position, to offset risk that you don't want to have inside your account. So options, those are like, I would say the 3 main strategies that investors, users will be using options for.
Okay, so a lot of applications here, an option for everything if you would, right?
Yeah.
You talked about calls and puts here. Let's give people a little bit more detail on what those are exactly. Take us through calls. What are calls? How do they work at a high level?
Okay, on a high level, a call option is a contract that gives the buyer the right to buy the underlying stock at a specific price. That's what we call the strike price, exercise price. That is the price that you can lock in to buy the underlying. No matter what happens to the underlying stock, you still have that right to buy the stock at the strike price. And this right is good until the expiration date. Now to have that right, you have to pay the option premium. Now who does this option premium go to? Well, it goes to the counterparty. The option writer, the option seller, AKA these 2 terms are interchangeable. So the option writer will collect that option premium from the option buyer. Then that investor will have the obligation to deliver the stock at the strike price if ever the counterparty decides to use his option to buy the stock at the strike price.
Okay, so call is if you're buying it, you get the right to buy a stock at a certain price, and if you're selling a call, you're getting a little bit of income in exchange for the obligation that you're going to have to deliver it at whatever that price is, right? What about puts? Puts are the other sort of major contract or option type here. Take us through what a put is.
Okay, so a put option, usually when investors buy put options, it's because they're bearish on the stock. They think the stock will be not doing so well. So they buy a put option to lock in the right to sell the stock at the strike price. So if the strike price or the stock price comes down, the investor who bought the put option will be making a handsome profit because he still can sell the stock at the strike price, which is going to be higher than the underlying price. So same thing, just like call options, the put buyer has to pay the option premium. Option premium goes to the counterparty. The option writer collects that premium, will take on the obligation to purchase the stock at that strike price.
Okay, so those are our two major contracts here, and these are the ones that all options strategies ultimately are built upon here. What I find really interesting about you, Richard, is that you've been trading options for 15 years, but you also know everything about options ETFs too, and that's your world professionally. So I'm curious, like, how did your options trading journey evolve over time?
Well, when I started like 16 years ago at the exchange, I was dabbing my feet into buying calls, buying puts, depending on what my outlook was on those stocks. And then afterwards, I started trading covered calls because I accumulated some shares. I'm like, okay, I have some shares here. Why don't I do a covered call strategy, generate some more additional income? So that was my journey. I loved it. It was very exciting looking at the markets every single day. My market goes up and down. My positions are going, very active. It's very passionate, something very different. But now with my current role, I'm more hands-off. My day-to-day is like lots of client meetings. I'm always on the road. So I'm using more option-based ETFs today.
I think that's a really interesting point too, because it's not like, those who can't or don't want to trade options would naturally have to do an options ETF. Even people who are really knowledgeable about trading options directly could also hold options ETFs, right? Like they're not mutually exclusive, basically.
That's right.
Yeah. Okay. So thanks for giving us the lay of the land here, Richard. And now I'm sure for those at home here, maybe a lot of you are totally new to options trading, or you're just getting your feet wet here. You probably got 1,000,001 questions about options. We want to hear them. Okay. Make sure you submit your questions to us. We're going to field as many as we can at the end of the show here. If you're watching on Webroker, use the chat box and you can send your questions to us that way. If you're watching in our broadcast platform, there's a questions and comments box that you can use. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform we have here, and that's where you can ask your question. Okay, Richard, I want to get to the heart of our conversation here, and that's sort of the pros and cons of trading options directly versus holding an options ETF here. I want to start with options trading here. It's Options Education Month here, right? That's what we're focusing on. Take us through, why would somebody want to trade options directly?
It's because you're in the driver's seat. If you're trading options, you're looking at the option chain, you're deciding on which option to trade on. Calls, puts, any stock or ETF, you decide, right? So you can also decide on the expiry dates, you decide on the strike prices, and you decide on the risk profile that you want. You can just buy the calls, puts, you can pair them together, create spreads, straddles, strangles, you name it, you have it. All you need to know is those two option types, calls and puts, and then you can create anything you want to your desire, right? So I think having the knowledge of using options and the ability of matching these different strategies together, I think it's a very powerful tool. And you were talking straddles and strangles, and I mentioned iron condors and all kinds of crazy named option strategies here. There's a lot there. Again, they're all based on calls and puts and stuff like that to some degree. But that said, there's so much options terminology out there, and I think that can really dissuade people from getting started, because it's like you're at the bottom of a mountain and you're going, geez, I have to climb this thing to figure it out. There's a lot to learn. It's a lifelong process to some degree of learning options. But in general, do you think, what are the high-level things that somebody would want to understand about options and options trading before they sort of dove right in? I think for the basics, learn your two option types, your calls and puts. Know your rights and obligations. Learn the lingo. Strike price. Okay, that's your set price, your exercise price, expiry date, exercise and assignment. So whenever you buy an option, you have the right to exercise the option. And whenever you're selling or writing the options, then you might get assigned. So these are terms that you need to be aware of and also understand what's going to happen after that process. What happens after when you call your broker and say, hey, I want to exercise these options, right? You need to have the shares or you need to have the cash, depending on the option type that you have. And then on the other side, if you're the option writer, if you get assigned, you need to know what happens afterwards. You also need to learn about, like, for example, implied volatility, historical volatility, because these are the things that you are trading, not just the direction of the stock. You're also looking at the volatility of the underlying. You're also looking at the option Greeks, because when we talk about options, we're talking about the deltas, the gammas, vegas, rhos, theta. So everything, these are, like, I would say, the basics, the starting kit when you want to start trading options. You gotta know these terms, and lots of resources and education material out there to help you along with that journey. For
sure, yeah, and like I say, it's a lifelong learning process to some degree, because even the basics is like a textbook like this thick, right, to some degree. And some of you folks at home might be saying, like, wow, that's a lot of stuff to learn about. We got you covered here. It's Options Education Month here at TD Direct Investing. You can go to td.com/OEM and you can see a full lineup of all the video lessons that we have here that break all this down into like bite-sized pieces. There's workshops that you can join with our masterclass instructors here, and they'll give you a sort of a hands-on walk through some basic options trades and stuff like that. And of course, you can tune into Inside Investing and our other live shows, TD Active Trader Live, to check out perspective from expert traders like Richard here and a whole bunch of others that we have coming up this month. So remember, td.com/OEM. Don't be afraid. Check it out. There's a lot to learn, but you can do this. You got this. Okay, Richard. Now, there's obviously different levels of option sophistication here. So what can you kind of break down, how could somebody get traded get started trading options? What are the different levels of permissions that they would need in their account to do this?
Oh yeah, that's a good question. Look, if you want to start trading options, you gotta call your broker and say, look, I want to get an options account, because that's gonna allow you to start trading calls and puts. Option level 1, very basic, very straightforward. You buy calls, sell calls, right? You get in, get out. Same thing with the puts. You buy puts, sell puts. Then after, you can also go up to option level 2, which allows you to do cover call strategies, generate a little bit of extra income on a monthly basis, quarterly basis. Then after that, you have your option level 3, which we talk about, like, which allows you to do spreads, debit spreads, credit spreads. And then last but not least, level 4, which is the naked strategies, where you can sell calls or sell puts on positions where you just want to do some funky multi-leg different strategies out there.
And you don't have to actually own the underlying stock to trade those, right?
That's right.
Just to clarify too, is there some kind of qualification that you need to have to get to level 3 or level 4, for instance, or is it just something that you're asking your broker, hey, I want to do this stuff, give me permission? How does it work?
You need to call your broker, you need to get the permission. They're gonna look at your knowledge, right? They're not going to give you level 4 right off the bat like that, because they need to see if you're qualified. Do you know what you're doing before they give you level 4 permission?
Okay. Yeah. So, hit the book, study up a little bit before you ask for level 4 or something like that.
Yeah.
That said, a lot of folks might be wondering, how much money do I need to even start trading options? What would you say?
Well, that's a good question. I did think about that. Look, if you're going to be buying calls and puts, your maximum risk is the option premium that you're going to pay. So if the option premium is $1.25, one option contract is 100 shares most of the time, then it's $125. So if you're going to buy 10 different options times 10, then that amount could be very, insignificant. But let's say when you want to do a cover call strategy, you need to have the underlying shares. You need to have at least 100 shares. Then let's say if you're going to do this on a tech stock, a $200 tech stock, so you can easily count how much that's going to require. So, you want to diversify yourself. You want to have an account with different names. You're doing cover call strategies. You're going to be buying some calls, some puts here, different strategies at the same time. But rule of thumb, I would say something between 10, 15, 20,000. That would be a nice amount to start with. And then you have to, trade up, get better, learn from your mistakes, and get your account size bigger.
Yeah, that makes perfect sense. And of course, there are ways to trade too without diving right in and putting all your money at risk too, right? You can start small and sort of build up from there as you go along here. I think a lot of people might be curious too, okay, I want to get started. You've convinced me that options are interesting, something I want to do. What's the easiest strategy, in your opinion, to get started?
To get started, I would say, like in my personal opinion, it's a cover call strategy. It makes a lot of sense because you're already holding the stock. So why don't you try sell one call option, which is on 100 shares, and just see how that works, right? Because you're clipping monthly income by using a cover call strategy. But from my experience from the exchange, I've seen lots of DIY investors, when they first hear about options, they see the potential in calls and puts. They get very excited and they start buying call options, put options. So those are different ways of getting started. But personally, I really like the cover call strategy.
And just take us through, how does a covered call work? What does that mean?
So a cover call strategy, first you need to do this in 2 steps. First step is that you need to have the shares, 100 shares. Okay, you can write 1 call option. If you have 200 shares, then you can write 2 call options. So by doing this, okay, you're selling calls on shares that you have. So this is why we call it covered, right? Because when you sell call options, you're going to be earning that option premium from who? From the option buyer, right? So the option buyer pays you the money, but he has the right to buy the shares from you at the strike price. So if ever the strike price or the stock price punches above the strike price, then most likely those shares that you have inside your trading account will be called away. You'll collect the cash, and then you can just continue with the strategy. You can buy back the stock when it comes back at lower, or you can move it to a different stock play. So it's very creative, very dynamic, and very flexible.
Yeah, and it's nice too, because if it gets called away, you don't have to go rush out to try to buy in the market those shares just to cover your obligation here. You've already got it. You can sell it for some from proceeds there, and at least make some money on it.
Exactly.
I get that. What about some of the risks, though, with something like, let's take, for instance, a covered call strategy. What would somebody need to appreciate? Sure, you collect income when you sell a covered call, but what are you giving up, basically?
You're giving up on the upside, opportunity cost, right? Never blame yourself for making a bad trade. If you're making a trade that's making money, it's still good. Let's say if you bought the stock for $50, you sell a covered call for a strike price of 55. Right? You're still getting that $5 upside. But let's say if the stock punches above 55, it goes to 65, don't punish yourself. You're still making money, because don't forget, the cover call strategy is an income strategy. You did this from the onset that you wanted to generate income with some upside to it, right? Some potential upside gains. So a cover call strategy, I would say the downside risk, it will be the opportunity cost, but also you're holding equity, you're holding the shares. Let's say if something really bad comes out on the stock, earnings were not that great, stock drops 20%, well, you're going to be holding that stock at a loss, right? Unrealized loss because of these, events. So these are the different risks that you might encounter when you do a cover call strategy.
I guess the upside in that situation is that, hey, at least you got some premium from selling some calls against it. So it makes the unrealized loss not so bad, right?
Exactly. You rinse and repeat afterwards.
Totally. What about just options in general, options trading? What are some of the risks that folks want to keep in mind?
Oh, option in general is taking on too much risk. I've seen many investors, they'll go in and buy too many option contracts. And these option contracts are way out of the money. So what I mean by way out of the money is, let's say if the stock is trading for $50 a share, they're buying a $60 call option. So it's going to require the stock to get like a $10 jump on the upside to make this trade profitable. So by buying these way out of the money call options, I think the chances of making a profit on it is pretty hard. So these are the different types of risks that beginners, option traders usually start off with making these types of mistakes.
Right. Yeah. And actually, just to kind of pull on that thread a little bit deeper there, what sort of habits, mindsets, best practices, if you will, would you say that some of the best options traders have that you think newbies might want to keep in mind?
Best practices, I think it's like start paper trading, know yourself, know the stock, know the market, right? These are things that you have to get yourself comfortable with to be in order to have that continuity, because trading is a long run, long-term gain, right? You don't want to just like make a profit today and then that's it, that's all. It continues. Markets never sleeps. So best practice, I would say, like, try to trade consistently, make profits, and then once you're consistent, then you can increase your trading size. It's always quality, not quantity.
Yeah, good rule to live by there in general, regardless of what you're doing. What just again on position sizing a little bit more deeply there. Do you think that there's like a rough rule of thumb, like how much an individual trade should make up of the whole portfolio of money that you have to trade options with?
Yeah, rule of thumb is about 2 to 5%. Let's say if you're doing an option trade, you're buying a call option, and you want to have at least 50 trades per year. That will represent like about 2% of your capital. You have to go with that 2%. I think like it's easier to recover if you're going in with a 2% maximum risk on a trade.
Yeah, you'd have to lose something like 30 plus trades in a row or something like that to wipe out your account if you're trading small positions like that. So
that's right.
You got a lot of cushion there for you. Okay, well, Richard, thanks for filling us in on the basics of options trading directly. Really appreciate it. Lots of great best practices there to pull out here. And of course, for those in our audience here, if you want to get started trading options, there's a lot of purposes you could use to trade options with. TD Direct Investing has a couple of special offers for you. So the first offer here, it's new and existing clients. They're eligible for a 1% cash back when they transfer $10,000 or more into an eligible direct investing account. So just open a new account with the promo code CASHBACK2025 and fund the account within 30 days. And you can also enroll an existing account using the registration form there. The second offer, you can get free access to streaming market data on the TD Active Trader platform until the end of 2025. Again, just open an account. You can complete the onboarding process there. As long as that's done between June 15th and November 30th of this year, you're good. You can scan the QR codes on screen for more details about these contests. They're fantastic, or offers, I should say. They're fantastic offers, great way to get started here. So make sure to check them out. Okay, Richard, so you were telling us about, sort of what it takes to trade options directly here, but there is a more hands-off approach, and that more hands-off approach is options ETFs. So take us through, what are options ETFs? How do they work at a high level?
Yeah, so, Canada was the first country to have option-based ETFs. So essentially what Canadians did is that they created a covered call ETF strategy and put that into an ETF. So a covered call strategy is a great strategy to generate income. Investors love that. So let's say I'll give you an example. If you're looking for additional income, where can you get that income? Rental income, dividend income, interest income. But from dividends, okay, let's say if you are holding a basket of Canadian dividend stocks, you have these stocks, what you can do to enhance that income is to use an option strategy, a covered call overlay. So that would enhance that monthly income, and that would be done for you within an ETF. So essentially, you're going to get that diversification because you're going to have different stocks inside that covered call ETF that generates that monthly income. And that monthly income is going to be professionally managed by a portfolio manager. So you don't have to worry about which stock to pick, which strike to choose, and which expiry to go with. And most times when we talk about these covered call ETFs, is that we take advantage of the time decay. The time decay of an option premium or option price accelerates when the option is getting close to expiry. So when you're using a covered call ETF, you're going to be able to take advantage of that because that's how many covered call ETF portfolio managers are using short-dated expiration dates in their mandates.
And basically the reason why somebody might want to hold an options ETF rather than trading them directly is just the fact that they don't have to worry about their trades, right? Like they don't have to manage that stuff. You can kick back, relax, let a pro do it for you, basically.
That's right. You let someone manage it for you. They're going to be able to roll those positions. Let's say if the stock price is getting close to the strike price, they're not going to wait until the shares get called away. Most likely what they're going to do, they're going to take this very active approach. They're going to buy back the call and then sell another one further out with a higher strike price. So there's lots of thought process behind these covered call ETF processes by the portfolio manager, and it's professionally managed at a pretty reasonable management expense ratio, or what we call an MER.
Right, and that's a lot of thinking and a lot of potential stress that someone else is dealing with. You don't have to deal with it. You just enjoy the performance, basically, of the fund here for a nominal fee here. Okay, that makes sense. What about the investing goals that somebody could achieve holding options ETFs as opposed to trading them directly? Like, are there enough options out there, no pun intended, with options ETFs that you could achieve a lot of the different goals that you could by trading them directly, or is it a little bit more limited of a universe, basically?
Look, with calls and puts, you can mix and match and create like different payoff diagrams, different strategies. But in the ETF landscape, right now we're a bit over $30 billion of AUM, asset under management, in option-based ETFs, with about 200 different ETFs like that in that option space. Look, we have covered call ETFs. Those are great for investors who want monthly income. But we also have like buffer ETFs. So those are protection that allows the investor to stay invested in the market, but with downside protection, with the holding period. Like, let's say, for example, a 1-year holding period, you have that protection. There's also leverage ETFs where it gives you some type of leverage on the investment that you're holding. So there are pretty well diverse different strategies that are using options inside these ETF mandates. I also want to highlight, we also have this strategy where they sell puts on quality names, high conviction names, and they write calls if ever the puts get assigned. So it's what we call a wheel strategy. So we're selling puts on quality names that you would like to buy. You're getting paid here, and if ever you get assigned on those puts, well, guess what? You're a shareholder now. So how do you get out of these shares? You sell calls. So again, you're getting paid to sell the stock. So that's the wheel strategy. So these strategies are very popular, very common, and that's what you can find inside an ETF wrapper in the ETF industry.
Yeah, certainly the wheel is definitely a popular strategy amongst more sophisticated, I would say, options traders. Just a quick note to our viewers here. We're actually going to be talking about the wheel with Marcus Heidecker later this month here. That's on June 26th, so make sure you check out that episode of Inside Investing. It's going to be a good one. He's got a great head of hair too, so really great speaker, great head of hair. You're going to want to check it out. In any case here, a lot of people like the idea of obviously earning income from their portfolios. I think that would perk the ears of a lot of folks here. So are there options ETFs that can help them achieve that?
Of course. There are so many. Like, especially, remember back then when interest rates were like at all-time lows? Investors couldn't get any yield from fixed income. Guess what? Lots of assets and money went into the covered call ETF space because of that income. The income was very interesting, was very attractive. It was paying more than fixed income. So for investors looking for income, a covered call ETF strategy, I think it's the way to go. You can have a covered call strategy based on high dividend stocks in a specific geographic exposure. It could be Canadian dividend paying stocks. It could be US high dividend paying stocks, European ones, global stocks, or even sectors, right? If you have a specific sector that you like, let's say, for example, banks. Who doesn't like the banks, right? So let's say inside that ETF, you're gonna have equal weight the banks, and then after what they do is that they sell covered calls on these banks to get an extra yield on those dividend payouts, right? So different sectors, different geographic exposures, all available inside an ETF strategy.
Okay, so lots of options ETFs to choose from here. That's really interesting. So if you have a goal in mind, basically what I'm taking away from your comments here is that there's probably an options ETF out there for you, and certainly covered call ones are really popular. Are there certain risks, though, that investors want to keep in mind when they're holding options ETFs? I know each of the strategies that they pursue might be different, but in general, are there certain risks that you want to keep in mind?
The risk would be, I would say, it's not going to have the same upside as an ETF that doesn't have a covered call overlay. Because what we're doing is that we're selling calls most of the time on half the portfolio. So that means that half of the portfolio will have unlimited upside. The other half will be capped, but at least you're generating that income. So it really depends on what your investment objective is. If you want income, I think the covered call ETF is a great solution for that.
One of the products that's really getting a lot of headlines, I should say, in the market here are these ones that they use some kind of covered call strategy or some other kind of option strategy more broadly. They might have leverage on them, and they have these really, really high yields, like eye-popping yields, like 30+%, 40+%, crazy stuff like that. What's the catch here that people need to appreciate with these products? Because on the face of it, it looks really attractive, particularly for someone who's interested in income. What's your take on these?
Okay, they're pulling some different types of levers, right? When you look at the option chain on the call side, you have different strike prices. You have at the money, out of the money, and in the money. To get a higher option premium yield, you're going to have to use either at the money or near the money options. That's where you're going to get the extra yield from. But here's the trade-off, is that let's say if you buy the stock for $100 and you're selling a $100 call, yes, you're going to get more yield, but there's no upside, right? If the call is in the money, gets assigned, you're going to be giving up your shares. Guess what? The portfolio manager will have to go and buy back the stock. Maybe the stock has already ran up. Then he's going to have to buy at a higher price and then sell another call option. That increases the transaction costs, right? But let's say personally, let's say this is my preference, I would prefer using an out-of-the-money call option. Why? Because I'm doing this trade, I'm getting some income, but also I'm having some upside to it. So I find like using an out-of-the-money is like a pretty nice balance between potential upside and also that income.
Right, and just quick clarification here, at the money being the strike price of the option is essentially what the current stock price is of the underlying stock there, and out of the money being that it's a little bit further out, so there's more room for some appreciation there.
Correct, exactly.
Okay, so if someone's interested in options ETFs, they want to check them out more further, what kind of criteria do you think are the ones that they would really want to key in on?
Okay, if they're interested in using like option ETFs, look at the MERs, right? Cost is one of the factors. Look at the fact sheet. I've seen some, some providers, they would say there's no management fee, right? There's no management fee, but there's other fees on the ETFs that they're holding. So those could be an increase of fees. So that you're going to find that information in the regulatory documents in ETF facts. So take a closer look of those because that's very important. The other thing is look at the transparency. How is the covered call ETF portfolio manager rating these calls? Which calls are they rating, right? Are they rating on 50% of the portfolio, 2/3 or whatnot? And when they do this covered call strategy, what's the strike price that they're using? Are they at the money, out of the money? So that transparency, I think, is very valuable because you want to know how that portfolio manager is going to be using this covered call strategy for your, the money that you're investing. Yeah, I mean, there's so many different ways they could be, writing these options and pursuing these option strategies. You really want to know what you're getting into here before you do. And and those fun fact documents are not nearly as intimidating as you might think when you first click on it, and it's like a bunch of pages or whatever like that. It's actually pretty friendly. So yeah, definitely check it out for those in our audience interested. Before we continue, I just have a quick question for everybody out there. If you're enjoying the show, do you want to learn more? Then you make sure to check out TD Direct Investing on our social media platforms. We're on YouTube, we're on Instagram, we're on Facebook. You can get a sneak peek at upcoming episodes and a ton of other content designed to help you build your investing knowledge. And speaking of social media, by the way, if you are interested in options, and you might also want to check out this.
The TD Direct Investing Starter Kit contest is officially live. Canadians can enter today for a chance to win one of 5 prizes with a grand prize that includes an iPhone 16, a check for $100, 5 educational books on options trading, and a 1-hour private Q&A educational session with a TD Direct Investing Educational Manager. To enter, visit the TD Direct Investing Facebook page, follow TD Direct Investing, and like the TD Direct Investing contest post dated June 2nd, 2025. You can also gain a second entry by following TD Direct Investing on Instagram and liking the contest post dated June 2nd, 2025. There's a limit of 1 entry per social media platform. The contest runs until June 30th, 2025. Scan the QR code for full contest rules and details.
I want to bring in my colleague Brian Rogers here because we're going to show you how to get started. Richard had mentioned paper trading as something that you can do. We're going to explain what that is here. So Brian Rogers, our senior client education instructor here, welcome to the program. Tell us, Brian, how can people start getting traded with options, learn, upskill trading options in a relatively risk-free way?
Yeah, no, I like what you said. Richard mentioned paper trading. You and Richard both talked about the fact that, you need to study, do your homework a little bit beforehand. You're going to learn that theory, but then that's really important to turn theory into application. And you can do that on TD Active Trader's demo or a simulated trading account. So you can just search online. If you're not a TD direct investing client already, you can call us as well. So search online for TD Active Trader practice account. And I'll share my screen right now. This is what it looks like. So I have it up already. And one of the things I would say is take like a three-step approach. Try and find or determine a stock that you want to buy a call on or a put on, some of those things you guys talked about already. And I just pulled up as an example, there's a number of watch lists you can find that'll have the S&P 500 different indexes and things like that. I pulled up Alphabet. You can see I'm on a trading tab. The trading tab has built in already an option chain, which is where you can find the prices for those actual options that are for that underlying stock. So if I pull up, you can see I have Alphabet up here. This is showing the stock price. And then down here, these are a number of the expirations. So as Richard had mentioned, there's a time-bound aspect to options, right? It could be expiring in 15 days, 22 days, 30 days. So decide on that. Find a stock that you think I'm bullish possibly on this stock, and I want to look at maybe locking in a price to buy at a certain strike price as an example. So you just click these little arrows. That'll show a listing of several of the strike prices. You can actually even change it up here. You could change it to all strikes, or you can even reduce the number a little bit if you want to make it a little bit cleaner here. But let's say if, as Richard had mentioned earlier, you could buy an option that's way out of the money. You can notice that's fairly cheap, but, be aware of what could happen, that, the stock has to go way up. You could buy one maybe that's at the money. But all you have to do that, so, basically the second step is to decide on what you want to look at, what strike price you want to do, what price you want to pay. You can do some filtering up here. There's a menu where you can filter the option chain for different columns if you're looking for information like the Greeks and things like that. But simply put, if you want to do a buy, you just click on the ask to do a buy or a sell. You can click on the bid. So if I just demo that down to the bottom, you can see there's the order ticket, and it's telling me I'm buying a $175 call for Alphabet, formerly Google. And if I want to do this in the demo or the paper trading account, I can go ahead and do it. I'm not going to lose anything. I'm not going to lose any money. It's fake money. I could become a fake millionaire, but I'm not worried about losing anything either. So I just click confirm and send, and that gives me some information here. I go send practice trade, and there we go. It tells me the order's filled, and I place the trade. And then one little thing on this too, just to note, I know there's so much you can learn. There's a learn tab even that's built in here as well that you can take a look at. And there's all kinds of material in WebBroker. But this is where you're going to see your trade. So this is the one we just did up here at the top. And then now I can follow. One of the ways I can learn is I can follow that trade and watch what happens in the market as prices go up and down and see what happens, how that option reacts.
So this is a fantastic feature, this paper trading feature here, Brian. You mentioned that education tab where you can learn a little bit more about the strategies involved with options trading. I'm wondering, can you give us a little bit of a closer look at that? Because I think a lot of newbies out there would wonder, hey, I'm going to be using that thing. How do I get back to that thing? What can I see there? So take us through it.
Yeah, well, we do have, we actually have a Learn tab. There's an actual widget. You can click on this plus sign here, for example, and then you can add widgets in from the very top. If you notice up here, and there's a Learn tab. So there's an education center. There's video lessons. This is mainly designed for the actual, let me see if I can get out of this here. Sometimes it may open up in another window. So there we go. Yeah. So this is HTML based. So if you want to open that up, that'll open up another window altogether. But you can also learn about the platform a lot more there. But if it's from a trading perspective, what I would recommend you do is if you go into an options tab, I created this one myself, you can use the option chain and you can actually learn a lot about those strategies that Richard was mentioning, like covered calls or iron condors and some of the things you mentioned from the outset. Rob, there's like diagonals and butterflies and iron condors. And you can, for example, if you want to know about a straddle, you can actually set the option chain where I can look for a certain time period, and it's going to design that trade for me. It's going to design the straddle. So if I do one that's fairly close to the money, about $170, I can click on the bid or the ask if I want to sell a straddle or if I want to buy one. And there you go. Voila, it's putting that into the option order ticket. And you can experiment with a trade like this. I can actually go ahead and put this through. Or if you wanted to do covered calls, if you're going to that next stage after buying calls and buying puts, like Richard liked to do, you can go to the covered call strategy. And now this is showing you to buy the stock. The stock is about 171, but minus whatever premium you're going to get. Let's say if you do a little bit out of the money call like Richard prefers, is now you can click on the ask, and that's going to actually show you down at the bottom. It's going to show you're buying the stock and selling one covered call, and it's going to include that premium. And then you can go ahead and place that trade, and you can kind of watch it from there. So that's where the rubber hits the road, Rob, and you can apply all of what you've learned during Options Education Month, and you could actually put that into practice on the paper trading platform.
Awesome, Brian. Thanks for showing us the ropes there. And yes, make sure to check out all the events we have in Options Education Month here, and you can test them all out in your paper trading account. Thanks a lot, Brian. Appreciate it. That's TD Direct Investing Senior Client Education Instructor, Brian Rogers here. And all right, Richard, thank you for filling us in on options ETFs and options trading directly here. That's all the time we have for the interview portion of our conversation here, but we're not done yet. We got lots of questions coming in from the viewers. Are you ready to hear what they want to know more about?
Oh, yes.
All right, let's get down to it. We've got Arvind here who has our first question here. And Arvind is asking, what are general methods for selecting stocks for options trading?
Well, it depends on your preference. Depends also on what stocks you like, what sectors you like. Sometimes some guys who prefer more option premium, they're going to go into more higher beta, more volatility sectors like tech, like energy. That's where you can get more option premium, right? That's where you're going to get yield. But if you're more as a stable guy who wants to have that consistency, then you'll go into sectors more like financials, bank stocks, something utilities, more stable. And then you get, but the trade-off when you go with more stable sectors is the option premium that you're going to get. The yield might not be as interesting as a tech stock option premium yield. So it really depends on your personality, on your nature, on your risk tolerance. Then ask yourself those questions, and then that's where you're going to find your answer. Okay,
so it sounds like really it boils down to what is the underlying and its characteristics, and that can kind of help you determine where might be a good place to start depending on what you're trying to achieve, basically.
Exactly.
Okay, thanks for that. Nozer's got a question here, and they want to know, when is the right time to sell or hold the call or put option? Should we be looking for a certain level of profit? And when does the option lose its value? So lots of questions in there to unpack here. Richard, enlighten us.
Okay. Depends on what you're doing. If you're buying the option, yes, ideally, if the stock is not going in your favor, close out the position. You don't have to wait until expiry. You can salvage whatever time value is left inside that option, right? And the other thing that you have to also be cognizant of is the decay in time value. As the option is getting close to the expiry date, maybe it's a good idea to sell a week before, or cancel your trade, get out, and move into a different option. Let's say if you're an option trader, I think option traders is that they want to do this strategy for income. So for that income, you can just wait until it expires if the option is out of the money. So that's a different way of deciding on if you want to keep that position or is it time to cash in and take the profit. These are the factors that you have to consider and think about.
I think it's interesting that you mentioned closing out the position earlier before expiration date in some circumstances here. Mm-hmm. Why is that? Why would you not want to take it right to the end?
No, you don't want to take it right to the end because look, the option, okay, it's going to start losing its value. The option is going to start to become more and more illiquid, right, when it gets to expiry. So that's why you want to get out of it before you get into the last week. Don't wait until the last week. It's like doing your homework. You don't want to be the last one handing in your assignment and doing that at the very last minute. Same thing with options trading.
I would say, speaking from personal experience, you definitely do not want to be the person who's getting their homework in at the last minute here. It doesn't help anybody, doesn't help you, that's for sure. Okay, thanks for that perspective here, Richard. T. Grant has a question here. They want to know, how are options profits taxed? Are they capital gains? Is it some other kind of taxation? In general, what would you say?
Okay, I have that question before, and also from my experience when I was working at the TMX, the Montreal Exchange, we do have a taxation guide on options trading. It depends on your primary source of income. If you're day trading and that's your primary source of income, then that would be taxed as income, right? But if lots of these option strategies, let's say you're doing a covered call strategy, those option premiums would typically be treated as capital gains. But at the end of the day, each trader, each investor has a different case. So I think it best is to go consult a tax expert for clarity on that part, or visit the Montreal Exchange website for that option guide on taxation.
Nice little name drop there, yeah, for sure. Yeah, and certainly, like, depending on your situation, yeah, you always want to check with a tax professional if it starts to get complicated there. What about options ETFs? Because these are distributions that they're going to be dishing out here. Are those treated as capital gains generally? Is that some form of like dividend income or something like that? How does that work?
Yeah, so inside a covered call ETF, that distribution will be primary capital gains or return on capital. But so that's why investors love covered call ETFs, because it's so tax efficient, right? Out of all the other types of distributions, capital gains is very tax efficient.
Yeah, you can't beat it in a lot of senses here. Let's keep the train rolling here. We got Rob, great name. Rob's got a question here for us. Rob wants to know, can you hold these ETFs, these options ETFs, in registered accounts?
Option ETFs, yes, you can. Option ETFs, you can hold that in taxable accounts, registered accounts. Now, talking about options, okay, you have your RSP accounts, registered accounts, and also margin cash accounts. Let's say if you want to do option trading yourself, right? You can't do all those strategies that we were talking about today inside a registered account. You can buy and sell call options, put options. You can do covered calls. But then when it comes to like doing spreads or naked strategies, you cannot do that in a TFSA or a RSP account. You can only do those inside your cash or margin account.
Why is that?
It's a CRA regulatory rule that they prevent investors to do other types of option strategies inside those registered accounts. It's always been like that. I think they want to, have a control on those option strategy types in those RSP accounts.
Okay, so basically double check that you can do whatever strategy you can do within whatever account you're trading in before you dive in. Okay, right. Good note there. Sanjeev has a question for us. Sanjeev is saying, what are good option strategies around quarterly result dates? Talking about earnings, I assume here. Usually there is higher volatility around these dates, and I can see what he's thinking here. Hey, higher volatility, that means higher premiums if I'm selling options.
Yeah.
What's the rub though, Richard?
Okay. Especially when you're trading around earnings or any FDA drug approval in the news, you have to be careful because there's going to be an IV crush. Once the earnings are out, right, everything's crystal clear. We know how much the company made. If it's a beat or under the analyst estimates, then what's going to happen to the option premiums is because the implied volatility all of a sudden it drops back to its historical average, then that trade might not be a profitable trade. So just be careful on these earnings dates of those stocks that you're trying to trade calls and puts on. I've seen many times where investors, they think that they're going to be getting the right trade. Yes, of course, earnings were great. They bought a call option. It's profitable. Stock went up 5%. But because of that sudden drop in volatility, they overpaid for those call options. So at the end of the day, they weren't able to turn this trade into a profitable trade. So be careful of IV crushes.
That's a tough situation because it's like you were right and you still didn't make money.
I know.
You were kind of wrong at the end of the day where it really matters, which is the bottom line. Interesting. Right. We got time for one more question. This one is coming to us from Gerardo, and Gerardo is saying, I am more of a passive investor, so what kind of returns might I expect from options ETFs versus just trading regular options yourself?
Ooh. If you're trading regular options yourself, you're going to have a nicer return if you know what you're doing, if you have the right trades. On, let's say, covered call ETFs, you can know that depending on the sector, you can know that you can get that return of the sector plus the monthly incomes. So take a look at the different ETFs that uses covered call strategies. You can look at their 1-year, 5-year, 10-year performance. Some ETFs will show you how much total return that fund is going to be providing. And I think that could be not an indication, but at least you know how it performed in the past as guidance.
Right, it can give you like maybe a rough idea perhaps of something to fall back on. Okay, another reason to go check out those fun facts. There you go, right?
That's right.
Richard, that's all the time we have for the Q&A and for this episode here. Thank you so much for joining us. Really appreciate all the wisdom that you've shared here. And for those in our audience, thanks for tuning in, of course. We love to have you here. Make sure you check out next week's episode as well, okay? We have Kirk Duplessis from Option Alpha coming in. He's our special guest. He's going to share his secrets to managing risk when trading options so you don't blow up your account with one wrong move, okay? And with a specific focus on income as well is what we're going to be talking about here. So make sure you tune into that. That's all the time we have for today, though. From everyone at Inside Investing, thank you so much for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.